The big thing today in financial news is the inverted yield curve. What does it mean? Why is Wall Street freaking out about it? And should you make any changes to your investment portfolio because of this? That's what this video is all about, so let's get into it. If we haven't met yet, my name is Mitch Goldberg. I'm a financial advisor and a business owner, and my videos are all about financial education. When you hear about the inverted yield curve in financial media, you're hearing a lot of lingo: interest rate spreads, positive spreads, negative yield spreads, etc. What I want to do is break this concept down into really layman's terms, and the first thing I'll do now is pull out some charts that I made just to explain this concept. The first chart I have, and please forgive me for my rudimentary artwork, but the first chart I'm going to show you is a normal yield spread. So for example, on this, I'm going to get nice and close here because I really just want to, spell this out for you. Here's a chart: interest rates up, time up that way, okay? And you have the 2-year Treasury. So when the U.S. government borrows money, the Treasury Department issues bonds such as 2-year Treasuries and 10-year Treasuries. And usually you get a higher yield on the 10-year Treasuries than you would on the 2-year Treasury. So the further out you go, you typically get a higher interest rate. The difference between the 2-year and the 10-year is a positive spread. So when there's a positive spread, what that simply means is that banks make money when they make many kinds of loans. So if a bank's cost of capital is 1% and a bank can loan the money out at 2%, well, then the bank makes a 1% positive spread. This is a little, I'm talking a little bit in generalizations, but I really want to use generalizations to get the point and the concept across. So that's a positive spread, and it behooves banks to make loans because that's what they do. It's profitable for them. But when you have the, when you have the inverted yield curve, it's kind of the opposite. So let me get my other chart here. So you see you have a normal yield curve, and the chart goes from the lower left to the upper right. When you have an inverted yield curve, the opposite happens, okay? Let me try to get in here nice and close instead of looking over the sheet of paper, okay? So now you have the 2-year over here. The 2-year is actually backwards. It's higher than the 10-year, and that creates a negative spread. So let's say, for example, okay, that the cost of capital for a bank is 2% and they make loans at 1%, 2 minus 1, okay, they're losing money on that. So what that means is banks will stop originating certain kinds of new loans to consumers and businesses. Now, there are many bank loans that are in the pipelines of banks. Those probably won't be affected. I'm talking about new loan originations coming out over the next 6 to 12, even 18 months. Those are the loans that would be affected. And therefore, that means money gets tighter, access to credit starts to get cut off for a lot of consumers and businesses. And again, that's what sends the economy into a recession. So conceptually, that's how it works. Now, is the inverted yield curve a reliable recession indicator? For the last 50 years, it's 7 for 7 in predicting the next recession. The last time we had an inverted yield curve was in 2005, and that was followed by the Great Recession. Now, typically, when we have an inverted yield curve, it can take anywhere from about 9 months to 2 years for a recession to set in. So it's very uneven. And it doesn't mean that necessarily the stock market has to go down for the next, year to 2 years. Sometimes the stock market goes up before we hit the next recession. So is it a perfect indicator? Should you be making any drastic changes to your investment portfolio because of this? I'm going to say no, absolutely not. Because if you're invested according to your risk tolerance, your time horizon, your financial goals, then a recession, a bear market, these kinds of things are already factored into your investment plan, or at least they should be factored into your investment plan way ahead of a recession or a bear market. The other thing to remember is that an inverted yield curve is not a perfect indicator. Remember that expression that people in my business have to use? Past performance is no guarantee of future performance. If you go back to World War II, there have been times when an inverted yield curve did not result in an economic recession in the United States. So it's not a perfect indicator, and there is no guarantee that we are indeed going to go into a recession anytime soon just because we have an inverted yield curve. So the real deal for this, it doesn't mean that it causes a recession in the future, and it doesn't mean that you have to do something with regard to your investments. If this video helps you out with your understanding of what an inverted yield curve really means, please give it a thumbs up. Please share it with a friend. If you're watching this video on LinkedIn or Facebook, leave a comment below if you have any questions about it. Certainly you're welcome to direct message me. And for more information, check out our website, clientfirststrategy.com. Thanks so much for watching, and I'll see you next time.